Yeah, so I sold all my dividend stocks last week, I think it was now, which is why my graph is looking kind of wonky. And let me just start off by saying there's obviously absolutely nothing wrong with investing in dividend stocks. But this is an idea I've been skipping around for possibly the last 2 months now. So dividend stocks are, I guess, assets that provide steady cash flow, steady income if you wish. And of course, the more shares of a dividend stock you have, the more dividends you get. And that is where I have a problem. I'm not really benefiting from investing £250 into a dividend stock that will then proceed to pay me, £30 a year? The reward is, of course, £30 for holding that stock, and everyone has their own financial situation, but I think it would be fair enough to say that £30 a year is relatively small. And yes, I understand the magical thing that is compounding your dividends and how it will play into your hands over the many years to come. But again, coming back to my situation, with the amount of money that I'm comfortable putting into the market right now, that compound rate will not have the effects that I necessarily want. I'm at a stage in my life where I believe I can take certain risk. The important word there being certain. I'm not trying to lose all my money. But I don't think I need to be thinking about how I'm going to maintain my wealth right now. I mean, look at my screen. I don't even have that much wealth anyway. What I feel like I need to be doing now is building that wealth. Building that wealth to a standard that I'm happy with. And once I've done that, then I can start looking at ways of maintaining the money that I have for investing in less risky assets such as dividend stocks and such as ETFs and whatnot. I like to think about it this way. Would I rather invest £100 into a dividend stock or build up my money so that I can put £1,000 into it? You could also argue that I could just have a portfolio that contains both dividend and growth stocks, but if I did that, I feel like I'm not really optimizing my potential of capital gains. It kind of sounds like I'm trying to get rich quick or build wealth fast, and in all honesty, I'm not gonna lie, I kind of am, but without taking on too much risk. That's where my head is right now, and that's why I sold all of my dividend stocks. Once again, I'm not saying dividend stocks are bad, but where I'm at right now in my life, I have a stable job, I have an emergency fund, so I should really be sticking out my head above the parapet a bit more and start taking more risks. Later down the line, I do intend to invest back into dividend stocks when I truly feel like they'll be beneficial. But as of now, I'll put them to the side for a bit. But yeah, that's my plan, build wealth and then maintain it. I'm expecting this now to be a more volatile portfolio with my so-called safe stocks gone. But as I said, I'm at an age where I think I can be acting a little bit crazy, not too much. And I'm happy to endure that because I'm only investing in what I can afford to right now. Of course, losing 13k is not ideal, but in an event that does happen, yes, I'll be unhappy, but it won't be the end of the world. If you have any thoughts, I'll be interested to know what you think. Nobody really leaves comments on my videos anyway, so suck you up. Nah, I'm joking. But enough waffling, let's go over to my pies and then just run through the stocks I currently have. They won't be in detail, it will just be a quick overview. So in my ETF pie, we have 5 instruments, and these are mainly focused around tech. I don't abide by these percentages, by the way. I just have them there to look pretty. I use an Excel sheet to sort out my portfolio allocation. So, the iShares Global Clean Energy is an ETF that I don't think I'll be looking to get rid of anytime soon. The same with healthcare. I think these are areas of, as it says, real innovation and importance in the future, so I'll be keeping those in my back pocket. The cloud ETF. I think the cloud is going to be and already is an extremely important component when it comes to the integration of computer systems and storing data, which is why I've invested into that. I personally use cloud services where I work, so I have first-hand experiences of its potency. Bitcoin, I just want small exposure to that in case that does become more prevalent in the future. It's not really one I'm exposing myself a lot to, however. I'm still not invested into it though. I missed an opportunity when it bounced off its 20-day moving average not too long ago, so I'm going to wait for another drop just to manage my short-term margins. And last but not least, we have the video game ETF, which is quite popular already. ETFs are, for the most part, safe, which kind of contradicts some of the points I made earlier, but some of them do have good returns and give me access to sectors that I'm too lazy to research, so I probably won't be changing anything about them anytime soon. In my growth pie, we have Trade Desk, which I see as a pick and shovel play, tdoc, which has had a great year this year, and I've seen people talking about how this year was just a one-off for it, and to be honest, we can't predict the future, but I believe it's in a league of its own when it comes to telehealth, and the same with Digital Turbine when it comes to pre-installed on-device features. I have Grow Generation, which I did a 5-minute review on. It's the largest hydroponic in the US with great financials but bookie management, so I would say it's definitely one of my riskiest stocks in this growth pie. Disney's Disney, right? Global known company that's also a recovery play, and with the focus they now want to direct towards its streaming platform, it seems destined for success in the upcoming years. I think this year we've seen Disney transform itself from a renowned dividend stock into a growth/spec stock. Tesla. I don't really need to talk about them, do I? Is it in a bubble? I don't know. I don't even think you can hand on heart agree with its valuation at this point in time though. But then you pose the question, are Tesla like the other automobile companies out there? And I don't think so. So it's definitely a future forward looking stock, but its metrics are a little bit far fetched for me at this moment. However, that's not going to stop me investing into it when I feel right. AMD, I've liked as a business for quite a while, especially since Lisa Su, the CEO, took over. They seem to be disrupting the microchip market, making headways there, fighting off the likes of Intel. Roku is a stock I chose instead of Netflix because of their healthier financials, and I just prefer the fact that Roku is home to various streaming platforms instead of being exclusive to one. PayPal is just a global dominant force that I seem to be emotionally attached to, which is not always a good thing. I don't think a lot of people know that Elon Musk founded it, which is quite interesting. I have Spotify because I believe they're the best music streaming platform. They seem to be expanding in the right places, and the music industry will keep increasing in value by millions to billions for years to come for sure. Celsius Holdings is a fast growing calorie burning fitness drink business with a loyal consumer base. As a beverage company, I'm not sure how much further it can grow from this point, but they are a great business, so we'll see. Last but not least, I have Square, which I've been thinking about replacing PayPal with, but how can you replace PayPal? They're such a global staple and have dominance in corners of the world where Square doesn't yet. So I think that's kind of what's holding me on to PayPal at the moment. Actually, this isn't my last growth stock. If we go over to my investment account, you can just ignore all these ARC pies, they're just for a bit of fun. But in my non-ISA pie, I also have NEO, which had a nice dip where I picked up some more shares, and then C Limited, which I sold Amazon and Alibaba for because I believe there's greater growth potential there, given where they are at in their life cycle compared to those. I'm not saying Alibaba and Amazon are bad companies, they're not for sure. In fact, they probably have a better run business than C, but I feel like C has more room to grow, if that makes sense. And so that's why I'm keeping them instead of those two. Right. Now coming over to my risky pie, we have Southwest Airlines, which I simply bought as a recovery stock. They had a really good balance sheet before COVID struck, which is why I chose them over everything else. But it might be a stock I look to get rid of actually, because even though they should, well, it's more of a hope that they get back to pre-COVID levels at this point. It may take a while, and with online meetings becoming more prominent, will business people still continue flying across the world just to turn up to meetings? There's a lot of money to be saved by continuing to take video calls like we're doing right now, so I'm not fully convinced business travel will return. I also have Uber, who have faced some challenging times in court this year and missed out on acquisitions, but I believe they'll prevail when they get their business together. I feel like they still have a lot of room to grow. Virgin Galactic, another spec play. Well, most stocks in here are spec plays, but space travel is something I've been fascinated by since I was young, and the guy that is Shamath, I'm not going to try and pronounce his surname, have really gravitated me towards this stock. I've also recently added Tattooed Chef in place for Beyond Meat, and this is because Tattooed Chef have their hands in more areas of the market than Beyond Meat, and I love a company that has diversified business, which is why I jumped on board with them. Boohoo have had their troubles this year in and around ethical practices, but with a bright future assisted with a healthy balance sheet, there's room for this stock price to shoot up. ipob, soon to be opendoor, are one of the best and first iBuyers in America. I think they still have a lot to prove in the upcoming years, especially next year with the financial predictions that they've made. But I'm willing to be an investor at this stage in the event that they are able to grow at the velocity they've predicted. Lastly, we have inmd, who I believe with their proprietary technology can help innovate surgical and maybe medical products as well, and hopefully should benefit from the reopening. But yeah, that is my portfolio as it stands. If you're interested in what my plans are for next week in terms of buying stocks based on where the price is as of right now, these are the following actions I have lined up. If you don't recognize the logos, you can find the corresponding names through my pies, which I've linked in the description. The logo in the first column on the fourth row is ipob, soon to be opendoor. I think that's one of the only logos, maybe Tattoo Chef, that you won't recognize in my pies. But anyway, I'm going to wrap things up there before this video turns into something a bit longer. I know over Christmas break and New Year, the market timers are going to be all over the place, so we'll see if I can stick to a regular schedule over that period. But that's it for this video. I'm out, and I'll catch you in the next one in a bit.